So you're probably going to want to brace yourself for this video because honestly, it's not looking good out there right now. Everybody is a genius in this bull market. Everybody sees their stocks going straight up and they just feel like they know something and they are very, very smart. The problem is that they're probably just getting lucky right now. And unfortunately, this isn't going to end well. We're going to go through multiple charts right here to prove my case. We're going to go through valuations. And of course, we're going to dive into my account to show you the exact trades that I'm making right now and how to capitalize with stocks and options the right way. We're not going to gamble. We're not going to day trade. Don't like, don't subscribe, don't clickbait till the end. Don't worry about all that stuff. Just pay attention to what I have to explain to you in this video right here because trust me, you're going to wish that you watched this all the way till the end, probably before the crash happened. But unfortunately, most people are just going to say, oh, well, I don't really care what Brandon says right now because I'm making a lot of money. Trust me, this video, you're going to wish that you watch all the way till the end so that you understand how to readjust your portfolio right now to make sure that when this ends pretty badly, you're going to be okay. You're not going to get caught with your pants down and you're going to know exactly what to do while the entire herd of people, they're going to be like chickens with their heads cut off, just running around, freaking out, not knowing what to do. All right, so let's go into the first chart here and let's just take a look at the Buffett indicator. And just for reference, everybody here hopefully knows who Warren Buffett is. He is one of the best investors of our entire lifetime. He has hundreds of billions of dollars simply by investing. And you can see that the Buffett indicator, which is his favorite way to value the stock market, it's completely out of control right now. You can look at the chart and see it's over 217% overvalued versus what it should actually be trading at if it was trading for fair value. And this is basically just a ratio of the total value of the US stock market, so like the whole market cap of the stock market versus the gross domestic product of America. So when you divide those together, you could see this is completely out of whack right now. To move on to the second one that makes this story look even worse, the price earnings ratio level is stretched right now. I talk about price earnings ratio so much on this channel. I know you guys are probably sick of it, but trust me, valuations honestly do not matter in the short term. Price earnings ratio level is a way to get a good valuation level of the market, but in the short term, the market doesn't always have to make sense. And when I outline what the short term of the market actually means, I view that as roughly 1, 2, maybe even 3 years. So in a 3 year period, valuations could get totally out of control before something breaks, something corrects, and it ends very badly. And just to show you how this really panned out for the 1999 crash, you could see the price earnings ratio level started at like, almost 6, which is very, very cheap, but it went all the way up to a level of roughly 45. Now you can see that right now we're trading at roughly 37 for the price earnings ratio level, which is a little bit hot. It is a little bit expensive, and you have to be very, very careful. Now, I just went through two things right here. Once we get to the charts, I'm going to compare the eerie, it's very scary, the similarities of what happened on previous crashes versus what's happening right now. Because just simply going through these few charts right here, it's just really not going to give you enough information. You're just going to say, okay, Brandon, I get it. The stock market's hot. Go do this. But it's not really that simple. And that's why we have to go through the charts where I put all the stuff on there that really makes you realize, like, wow, how are we so blind to what's really going on behind the curtains right now? And why am I having my portfolio allocated in such a crazy way that when this event happens, which it will eventually happen at some point, I'm probably going to get reset at zero. I'm probably way too leveraged right now in the wrong stuff. You could take on leverage right now. You could do options right now, but you have to do it on the right stuff. Okay. So the third thing here for market valuation models, you can see the price sales model is overvalued. So basically what this is saying is this: how much is the market cap of a company and what are their total revenues? It's very simple to break that down. And you can see that going all the way back to 2001, we are higher than what it was back then. We are higher than 2008. We are higher than what happened, with the dip when we raised interest rates because inflation was getting out of control post COVID. So things are hot on the price sales ratio also. Now, a lot of people are going to say, well, Brandon, that's because it's AI. AI isn't really materializing yet. These companies are new, they're startups. They don't have a lot of money coming in just yet because they're still, proving their model and trying to get some contracts going to make some money. But I say this: what about in 1999? Anything with a .com behind the name was doing very, very well. But understand that 95% of the .com companies failed. Amazon, a company that didn't fail, it went from $106 per share down to like $5 a share. The company's great, but look at that difference. Look at how far the stock actually fell. So if we look at what's going on right now, sure, companies like Nvidia and AMD and TSM and whatever companies like that, they're making a lot of money for this AI build out. But there's also a lot of zombie companies right now that aren't making any money. They're not even making any top line revenue. It's one thing to get, earnings per share, but it's another thing to not even have revenue. Like you can't have profit and earnings per share unless you have freaking top line revenue. So you could see price sales ratio is definitely overvalued. Now, if we look at interest rates, you guys know by following this channel for a long time, I talk about how interest rates are gravity. As interest rates go up, stock market valuation should come down because everybody wants to find the best risk adjusted return. If you could get a guaranteed rate of return of 10% in a bond versus a risky rate of return of 10% in a stock market, everybody's going to go with the bond because why would you take the risk of the stock market if you don't have to and you'll get the same dang return? So, as interest rates fall, this is going to come into a better balance. But right now, the valuation level that the stock market is trading at relative to what interest rates are at, it's saying, look, it's still not justified. And I get it that we're going to get some interest rate cuts for this year. Still, we have 50 basis points in the pipeline, which is a 0.5%. It's going to help, but it's probably not going to be enough to save this market. So as we go through this video, we're going to progress through all the bad things that are happening right now, all the charts, all the data, and then I'm going to give you a very clear explanation as to what you could do in your portfolio to really just capitalize on this. You know, there's a lot of people on YouTube, and let me just go on this little rant here really quick. There's so many people on YouTube that make their videos that are all scripted. They say, go like, go subscribe, go buy this thing, watch until the end, drop a comment, turn a notification bell on. Like, I'm not here for that stuff. I'm here to talk to the person like you that is an everyday investor that doesn't understand what to worry about, sees so much noise out there, doesn't know what matters and what doesn't matter. I'm simply here to break down what matters. Forget about the noise, forget about the BS, focus on what matters, how to invest with a long-term portfolio, and we could do short duration plays too, how to do it in a low risk way, and how to use stock options the right way to capitalize, and how I generate, if we go to my account, I generate on average like $30,000 a month in cash flow by selling options and buying options. It could be done. I could make more cash flow if I really wanted to, but why am I going to take on that risk? I mean, with what's going on in the market right now, does this seem like a good time to take on a crap ton of risk in the market? I mean, in my opinion, no. And I get it. We've all been making a lot of money the last couple years, but it's time to be a little bit more careful. And we'll talk more about that in just a second. But mean reversion, this is something that I pound the table on that matters so much. Reversion to the mean is basically this idea that stocks follow what earnings do in the long term. So if earnings go up 100%, but the stock goes up 200%, the stock is outrunning what the actual profits of the companies are doing. So there's that disconnect. But eventually, what will happen is you will have reversion to the mean where the stock or the stock index is going to fall down to where the earnings growth is. And I'm going to show you a really good chart on that in just a second. I didn't show you that in the beginning of this video because I am going to promise you that these two lines are probably going to overlap at some point. And when it does, I'm willing to bet that most of the people that you see on YouTube and X and Instagram or whatever, most of them are going to get wiped out. They're going to get caught with their pants down. But if you follow this channel and you understand what I'm talking about here, you're simply just going to be prepared. So let's go into the first chart. You can see that this goes from 1994 to roughly 2007. Okay. You can see the stock market made a really big rally. This is the S&P 500, by the way. Big rally up, 244%, going from 94 to 2000. So a 6-year rally, 244%. The top blew off, market fell 47%. And if you just really think about it, look at my cursor right here. Actually, I'll just draw you a line. Like, why didn't the stock market just follow this line that I just drew right here? This is what the earnings per share was doing of all the companies within the S&P 500. Why did the stock market not just follow that? And that's simply because people get overzealous, they get emotional, they get FOMO, they simply don't want to miss out on the big returns to come. And a lot of people made a lot of money on the upside, but a lot of people gave all of that back plus more. A lot of people honestly gave back their home because they did, leverage plays on it and did HELOCs on it and just did all this crazy stuff. They got wiped out and they got smoked because they were geniuses in this bull market going up. So again, how could investors get this so wrong? It's just simply because human emotions do not change. History does not repeat. The title of this video, it's on the thumbnail, history is repeating because it is right now. And when I show you what's happening, for 2025 and we compare that to what happened in 1999, you're going to be like, geez, I really got to look at my portfolio because I might have this all wrong. We'll get there in 1 second. Okay, chart number 2. You can see this goes back all the way through the 1999 dot-com crash and then what's going on right now. And the first thing we could look at is this. You're going to be like, Brandon, the market went up 244% then, and then the bubble bursted, and now it's up 130%. So we're not even close to where it was in 1999. And you're kind of correct, but you're also kind of incorrect. Understand that, like, go back to the initial chart. The market fell 47%. I'm not saying the market is going to fall 47% right now, but maybe it's going to fall 30 or 35 because it's not as overvalued as then, but it's pretty darn close. And if we just go back to the chart right here, you can see for the Buffett indicator, like we're way up here, but in 1999 it was actually lower. But you can see the price earnings ratio level was higher then, and we're a little bit lower right now. So on balance, we're very similar to it, if not maybe slightly on the higher side. Like mean reversion model, we're higher right now. So this is something to be concerned about, and it's definitely something to look at. So let me get myself out of the way. Let's dive into this chart a little bit more. So earnings per share, you can see this is a trend of earnings per share, this solid line right here in 1999. But earnings per share, if I just do it on the bigger chart, let me get myself out of the way, you're going to see that earnings per share is trending up roughly at the pace of what I'm drawing on this line right here. Something along this line right here is where earnings per share is growing at, right about there. So you could see if we figure out how much farther the market could actually fall to get to where earnings per share is actually at, we're ending up roughly 20% overvalued. That's a 20% drop from where we're at to where the actual earnings per share is at. And if you don't understand how I plotted this line right here, I get it. I'm not trying to pitch you my course. I explain all this stuff in the course. The link is below if you want to get in for absolutely for free for the first few days. But you could see the market's hot. Reversion to the mean will happen. The market just goes a little bit above the line, a little bit below the line. So this might indicate the market's cheap right here, and this might indicate the market's expensive right here, because it really is. And if we just go over to this chart right here showing you valuation levels in a very simple way, and this chart did just update, so it's critical to look at now, 1999, the S&P 500 was trading at roughly 24 to 25 times earnings. You can see the red line's the S&P, the blue line is the price earnings ratio level. Right now, we're right around 24. We're very, very close to that line, 23, 24, whatever it is. This could go up a little bit more, but not really that much. And if we get a hint of bad news, a hint of a trade war, a hint of whatever, the market's going to fall like a rock. A hint of AI capital expenditures slowing down, a hint of Nvidia slowing down. And I did just listen to the Tesla earnings report last night, and it's like, dude, Elon's talking about some crazy stuff. He's talking about how Samsung is better than TSM. He's talking about how they're going to make their own chips and not go with Nvidia anymore. Like, there's a lot of crazy things happening right now in this AI sector that not many people are really looking at. And the fact that the S&P 500 and the NASDAQ, Nvidia is carrying the weight of that index so hard right now. If something bad were to happen to Nvidia, or really they just take a breather, the whole market's going to go down with it, and the whole AI sector is really going to get dragged down with it. Because as the AI sector keeps pushing higher, it becomes a heavier percent of the S&P and the NASDAQ because it's market cap weighted. So the risks are building as those things keep going up, because as they keep going up and getting more expensive, the downside risk becomes higher. And all that's at a time that, the price earnings ratio level is a little bit high. We went through this stuff here. You see that that's a little bit lofty. This is a time to be careful right now. So let's dive into my account. We're going to go through what's going on, how to capitalize, how to understand options, what I'm doing in here, and how to just do this stuff in a low risk way, because there's just simply so much BS online right now. Like, I don't even care if these videos get views. I'm here to talk to people that actually want to make money and not just watch a video that's completely scripted out and, they're just reading off a teleprompter. Like, this is all off the cuff right now, but this is how YouTube should actually be, in my opinion, because we're just talking. We're having a conversation about what the heck is going on in this crazy stock market. Okay, so I have my base portfolio, VOO and Triple Q. Tesla's in there too. Been making a lot of money on it. You can see my cost basis is $149 a share, and now it's at almost $450. It's crazy. I did do a very, very, very deep breakdown on Tesla in Discord, and I also talked about it on a Zoom call a couple days ago. Again, free to get in. You could just go check it out and then cancel if you really want. You'll never get charged. You should definitely go check out what I talked about on that, though. You'll get a lot of value. But here's my point here. Overall leverage in this portfolio. How much leverage do you think I have right now? Like, look at it. What is leverage? Leverage is options. Leverage is sold puts. Leverage is bought calls. I have some exposure to United Health. but I also am up a crap ton of money on that. And I think that United Health is going to keep going up. Also, if the economy takes a crap, if the tech bubble happens to pop, United Health is kind of uncorrelated with that. Everybody still needs health insurance. Like, just because the market crashes doesn't mean people are going to cancel their health insurance. Like, they're still going to take that. So this is kind of like a counter cyclical play right here where it's kind of defensive in a way. Now, BLV, I talked about it all the time. If we think interest rates go down because the economy takes a crap or something bad happens, this is going to do well. BLV will appreciate in share price. Amazon and Meta, these companies fundamentally right now are trading below intrinsic value. They have a moat, they have pricing power, they have a durable competitive advantage. I'm okay to hold these companies for the long term. So I sold some long duration puts. I picked up roughly, $35,000 in premium. What that means is I literally collected $35,000 for doing nothing. And just think about this. Let's just say this out loud. Does anybody in here want to buy Amazon stock for 190 bucks per share, 12/17 of 2027? And I'm going to pay you $23,000 to do it. How many people in here want to do that? I want to do it because the company is going to be bigger, better, stronger, more revenue, more earnings per share. Sure, give me the shares for 190 2 years from right now. I'll gladly buy that. So then I take this cash flow and I go invest it in something. And I usually don't sell monthly puts, I usually sell longer duration puts. And the reason why I like to do longer durations is because if I feel like Amazon and Meta are cheap right now, I want to generate big cash flow. Because if I would sell a 1 month put on Amazon, I would maybe pick up like $1,000 to $2,000 in premium. But I picked up $23,000 in premium, and then I could use that money to go buy something else or just go buy Amazon straight up. Because if I'm selling a put, that means that Amazon's probably cheap. So why not just go buy Amazon shares, which I probably will at some point. So, this is just a very broad overview of what I'm doing with options, but, you'll see so many people online that are buying 2 week call options right before earnings and are basically just flipping a coin, and they simply just get lucky if they make money. Like, this strategy, it works. I'm not saying it's the most exciting thing in the world, but that's why in Discord I have this AI bot that sends out like 10 trades a day, and we follow that with a very small percent of our portfolio. So maybe 5% of your account you could go speculate with, but the other 95% of your portfolio, that's going to be your core holdings where you're basically just buying and investing for the long term. Whatever profits you make by selling puts, add it to the base portfolio or add it to the shares that you're buying right here. And then you just let the companies work for you. You let the earnings per share gradually go up. You let the revenue gradually go up. You get this tailwind of America and these companies and what they're trying to do. They're making these plays higher likelihood of being profitable for you because you're betting with them. You're betting that the share price is going to go up with time, not overnight, not in 1 week, not in 1 month. That's the way that you do stock options. Again, I speculate with a small percent of my account. I have a Robinhood account and I do some other speculation stuff in here. Like this, for example, is one of the speculative things that I'm doing. It's a very, very small play. I just opened this one up like yesterday, I think, very small percent, but it's doing well so far. We saw that there's a lot of unusual volume on certain call contracts on Circle, so we followed it. And there's other reasons why we followed it too, but it's all in Discord for that bot. But to be completely honest with you, I don't care if you join the course in Discord or not. That is not the point of this video. The point of this video is this. There's a lot of noise out there. There's a lot of geniuses out there. And there's a lot of people that, in the last couple years, they made a lot of money. I made a lot of money in the last couple years too. Like if we just flip back to Schwab, how much is this account up in 2 years? I think it's like 170% or 199%. Like, I made $820,000 in 2 years. Like, and I did that in a low risk way. I could have made probably $5 million in the last 2 years if I really wanted to, but I don't want to take that risk and then get reset at zero. So that's what this channel is all about. I'm trying to be the guy that shows you guys how to do stocks and options the right way. You're probably not going to come over on this side of the equation until you do it your way and try to do, day trading and short duration plays. You're eventually going to lose money. You're eventually going to get smoked. But when you give up on that and you want to come over to the good side, click the link below. I think you're going to get a lot of value in it. It's free for the first couple days. Go through it and cancel if you want. And with that being said, if you got value, now I'm going to ask you, like and subscribe if you want. I'll see you guys in the next video.